Now, I said when we started with gold in a major way just under 25 years ago, I said that gold will reach $10,000. That wasn't a forecast or a target. It's just, you know, that when you come to the end of the monetary era, the acceleration will take place of the currency debasement, and therefore gold will reflect that. So 10,000 is just a nice round figure that was likely to be reached.
There is something setting that we're watching here, and we haven't committed ourselves to either direction, but we've benefited from the down leg for now by being long silver. So we're not aggressively long silver. We think it goes through, we think it has a chance to get back towards the $100 mark on the upside, but that it'll start to run into, we need more winding up, because this pattern is showing us that there's more winding up to happen before we get clear signals on all fronts.
Gold is entering a phase shaped by monetary stress and currency debasement. As fiat systems weaken, prices rise more sharply. The $10,000 level illustrates the degree to which currencies can erode in late cycles, reflecting a broader repricing of real assets. Francishunt, a specialist in large-scale technical patterns, and Egon von Greyerz, a longtime advocate of gold as financial insurance, explain that after nearly 25 years of tracking this trend, the current environment aligns with the final stages of monetary expansion. With global debt exceeding $300 trillion and central banks purchasing over 1,000 tons of gold annually, the macro backdrop continues to support higher valuations. They note that gold's move toward $10,000 is driven by accelerating currency debasement, while silver has benefited from recent downside positioning, but is not yet in a full breakout phase. The setup suggests a potential move toward $100 in silver, though further consolidation is required before confirmation. The market remains in a winding up phase with building pressure. Momentum is forming, but patience is needed as the structure develops. Focus is on confirmation, allowing the trend to mature before the next move higher. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
And now, of course, we are in the acceleration phase of the debasement of the currencies. It's not a forecast, but it's an interesting way to look at gold and silver. Now, I said when we started with gold in a major way just under 25 years ago, I said that gold will reach $10,000. That wasn't a forecast or a target. It's just, you know, that when you come to the end of the monetary era, the acceleration will take place of the currency debasement, and therefore gold will reflect that. So 10,000 is just a nice round figure that was likely to be reached. And remember, at the time when we started with gold and silver, gold was around $300 we bought gold at in a major way in 2002, and silver was around $4, I think, at the time. So we now seen a massive growth to $5,000 in the gold price and similar in the silver price. But this is just the start of the acceleration of the precious metals, for the simple reason that, as I said, the way we measure it is going to go down by at least the same amount, if not even faster. Now, so what does that mean in relation to the $10,000 gold price? Well, it means that we are very likely to reach it, and I think probably a lot higher, because final phases of the debasement of currencies, as we saw in the Weimar Republic, for example, is very rapid. Now, 10,000 gold in silver terms, if we take the historical ratio of 15, that is 15 times the silver price is the gold price, or the gold price divided by 15 is the silver price. So 10,000 gold divided by 15, which is the historical ratio, as I said, that means $666 for silver. Now, some people are superstitious and don't like the 666. I'm not superstitious. 666 is just a good number. It probably is a lucky number if you are a silver holder.
You asked about gold, so I feel I bring up the gold chart, but the one I want to show you is actually the silver chart. So gold is overall in what we would describe as a continuation pattern, but it's of a broadening nature. So you'll see our chart with lots of work. The only part I really want to show you is this, so I'll just highlight it. This is typically continuation, even though there's been some harsh sell-offs. It's just a bigger time frame one than most people would have liked. So the time before you're making new highs, obviously there's a delay in that. So that's your broadening structure, and you typically have waves of 3 selling. One wave of selling, here's the secondary wave of selling, and now you are rallying quite strongly. At our splitter, you got a bit of a reaction there. I think you go up and then you get up possibly to the side, and you might have a moderate wave of selling before we finally break the broadening structure, which will then be break, return move. We'll start to get new highs. More interesting and more immediate is actually the pattern that we got on the silver price, which is what I wanted to show you. And that has broken sooner in its continuation pattern, but it had the harder sell-off initially and the less violent one at the secondary level. So it really got spanked. And I think the biggest problems was in the supply chain of silver, and they really needed that to come down. So if I put them above each other, this was brutal for silver, the first sell-off. The secondary sell-off, whilst you did sell off, was not as violent if you look at the relative lows compared to gold that I just had up. And I can put them one now. We only went marginally lower there. And the pattern that we liked that is on display, there was the falling wedge pattern instead of a broadening pattern. It looks like that technically. So you had this capping descending grind line that is one subsector of a falling wedge, which is the point at which you're being knocked back continually. That has been broken. You had a nice little hammer there technically as you were bumping up against it. You broke, you traded up, you got knocked back, and you've been resting. You went a little bit up, got knocked back, and now you're moving up. Now, today, you're having a little bit of a rest. We had a pretty good day yesterday. And this is silver getting away. So this one has broken its continuation pattern. Does that mean I expect it to rip to a new high? No, because of the extremity of the volatility introduced by this sell-off and the secondary effect of the second sell-off, we still see you working your way up moderately, and there's still a possibility of another sell. We think you'll get in due course. We're not in blow-off phase like we were near the end here. In due course, we think you're going to get up back through the 100, and then you might sell off again. So we're expecting an even bigger continuation pattern to form. So we are currently long silver and short Brent. In terms of our positioning, and nothing on gold at the moment, out of choice with silver being better. And actually, we've been rewarded for that because the gold-silver ratio has actually been coming off in favor of silver. And I want to highlight that as well before handing back to you. There's the gold-silver ratio, and you can see, having been as high as up top there, you've actually been spilling off a bit down now. So there is a structure forming here, and the question in the future, and this is why I say I don't think you just rush to new highs on silver. You are over here, you could come down a bit more, you might go up. I think we're going to get some form of pattern there. That'll either be an upside break, that will be deflationary and down for both, more so for silver if you break to the upside. If it turns out into a downside break, that will be very bullish silver, and we'll be going back and reasonably to good bullish gold. So there is something setting that we're watching here, and we haven't committed ourselves to either direction, but we've benefited from the down leg for now by being long silver. So we're not aggressively long silver. We think it goes through, we think it has a chance to get back towards the $100 mark on the upside, but that it'll start to run into, we need more winding up, because this pattern is showing us that there's more winding up to happen before we get clear signals on all fronts.
Gold and silver are entering what can be described as the acceleration phase of currency debasement, where price moves are no longer linear but begin to reflect deeper systemic stress. The idea of $10,000 gold is not framed as a prediction, but as a natural outcome of prolonged monetary expansion, especially considering gold's rise from around $300 in the early 2000s to its current elevated levels. Historically, late-stage currency cycles, such as the Weimar Republic hyperinflation, demonstrate how rapidly asset prices can reprice when confidence erodes. Silver, meanwhile, is showing earlier signs of structural breakout following a severe initial sell-off and a milder secondary decline. The formation of a falling wedge pattern suggests a constructive trend, though volatility remains elevated. While silver has the potential to move toward $100 and even higher over time, current conditions suggest a gradual climb, with further consolidation likely before any major breakout. Let's get back to the interview.
Now, as I said before, I don't think the gold price will stop there. I think it'll go a lot higher because, as we said, the final phase is an acceleration phase. So we will see a lot higher prices in gold and silver measured in today's money. Now, I could easily see the gold-silver ratio not stopping at 15, but going down to 10 or lower, because in these final phases of a move, prices normally accelerate a lot further than the norm, if you want. The norm is the historical norm of 15 of the ratio. We could see still lower gold-silver ratio and therefore silver price, which accelerates much faster than gold. But remember, it also corrects very fast the other way, which we just saw at the end of January when all the metals corrected. But that was a correction, what we saw at the end of January. We're still in the bull phase. I expect this to last in this cycle. In the short-term or medium-term cycle, I expect that to last another few months, whether that's 4 months or 6 months or whatever, to a lot higher levels. And then we might see at some point a pause for a while until the long-term trend continues for, could be a couple of years, it could be 5 years, it could be 7 years. It doesn't matter. You know that the risk is there, and therefore you have to hold gold and silver in physical form. So there are many factors that will drive this gold and silver price and the debasement of the currencies. Now, obviously, like George Bernard Shaw, we must not trust governments, because the governments are, without fail, always destroy the currency. And we're now, as I said, in the final era of this monetary system, going from $35 an ounce in 1971 to $5,000 today, and to 10,000 and probably a lot higher in the next few years. Now, Shaw said, you have to choose between trusting to the natural stability of gold and the natural stability of the honesty and intelligence of the members of the government. And with due respect to these gentlemen, I advise you, as long as the capitalist system lasts, to vote for gold. Really, what Shaw said is that don't trust governments, don't trust what they say, look at what they do. And the consequence of what they do has been throughout history that they destroy the value of the fiat system. And therefore, you have to hold gold and you have to hold silver in physical form and store it outside the banking system in safe jurisdictions. And obviously, you have to have direct access to your metals also. We are, as I have explained many times, we are at the end of not just a monetary era, but with that end of monetary era, it means that inflation will be accelerating and the whole commodity market will reflect that, because we're going to go now from paper assets to real assets. So we will see major falls in stock markets and bond markets and many other bubble asset classes. And commodities in general will reflect the inflation we're going to see. Now, obviously, gold and silver stocks will benefit greatly from this move, and many of them move up a lot faster than the physical metal. But we have to remember that holding the stocks is another level of risk and not pure wealth preservation, because holding the stocks means that you're holding it within the financial system. Banks or asset managers are custodians of this gold and silver, and therefore if something happens to the system, you're not going to be certain if you actually get hold of your gold and silver, and you're not certain what they have done with your shares, if they have pledged them, etc. So therefore, by all means, hold gold and silver stocks, because the potential is enormous. But remember that the only true form of wealth preservation is physical gold and physical silver, and as I said, stored outside a fragile banking system. As I've said before, we're now in the acceleration phase of this move of gold and silver. It's going to last many years, but there are cycles within that. We're going to see the acceleration now. So do not get rid of your gold and silver. And if you don't own it, buy now, because as I said, the next phase up is starting soon and it's going to be very strong in my view.
What then tends to happen is we have the stagflation. So you're going to have assets contraction. You're going to have cost of living going higher. So the Hormuz and the Iran narrative that you've been fed is all part of a justification for increasing prices. So CPI is going to move up. We've also seen rates on bonds across the board, Japan, Europe, the US, all going up, which, as you know, as a regular appearer with you, for many, many times we have said, higher for longer, pullbacks will be much shallower and much shorter, debt debasement needs to happen. And that's the stagflationary environment that has a parallel to the 70s, but is far more extreme because the overall debt to GDP is far higher. So in terms of your question, I'm looking at, we're going through various stages that are being engineered. And you're going to have the hyper stagflation, which is the more extreme version of stagflation now. It's going to be very bad for the average man and even the middle class and upper middle classes. The billionaire classes do very well because the debt gets debased, that they have borrowed and bought assets, built data centers, whatever the case may be. So then when you are in that weak general consumer environment, but the super rich, what do they do to stimulate the economies? It's kind of like a depression, and I can see us rolling into that. You get taken to war. So your questions around Hungary and the moving of the thorns from the side will then see even Hungarian males potentially being enlisted when they become a more pro-EU, anti-Russia type environment, which coincides recently with some publicity that's gone on in terms of German males. We were discussing between 17 and 45 and having to register with the military if you live outside the country. Everyone is now, who's our meat for the meat grinder if we do this global war? And I think they intend to do it. And it's going to be a massive hollowing out of males in the white European and the Russo-Slavic space. And I'm not for it. And I think it's wasteful. And there is no definition of winning that's positive in any way. But I think they're going to engineer it to happen. So I don't know if that helps. I'm seeing it in blocks and stages, and I'm describing that. I'd imagine we're going to have the recession fully reflect again, and that's going to be the stagnation part of the stagflation revert. And that's going to, energy gets hurt by this. This is why we always say gold outperforms oil. And you will go back to gold outperforming oil because gold will always reflect the fullness of the extent that fiat has been proliferated. But oil, if it goes up too much, eventually, because of its inflationary context, does too much economic damage that it leads to deflation. So the inflation creates the deflation, if that makes sense. So we are seeing a broadening structure here after quite a vicious gap that was on the kind of fake peace announcement that I think the Trump family members were front running and trading on Binance. You know, you're in a complete cacocracy of morality here in terms of the political classes. And that was a huge gap. You know, you don't get a gap like that. That has to be looked at differently, and that's a broadening structure on a bearish pole, and this is our ascending. So we call it the ascending first inverted HVF in a new trend because everybody has become such bulls on the oil price that they've chased it up along the lows. So you see the lows here, you're very steeply ascending coming up here. So I should probably do that in a thicker Koki. You can, so it pops a bit more, but those are your lows. So you've had too high, yet you're not being let through to break out the top. And that's quite clearly, everyone's quite happy to sell at the 112s. The providers are happy. There's plenty of oil, Kai. There isn't a shortage of oil. Remember, this is supply chain related. And they're letting it through, and people are seizing the opportunity to unload at these levels. So I think this reverses, and we are going to break down out of this broadening structure. And in due course, we're going to fall through 68, 78. And this is why we are predicting the May, sell in May, go away in St. Leger's Day, the great typical trend. So tech stocks down, a lot of things down, interest rates and debt-based crisis could be the problem, and this becomes far more financial, economic, and less about Hormuz and energy. You're going to get a bit of fatigue. I think you referenced that yourself. So we are calling short now, given this event and this gap down to oil, having not so long ago put out a video saying we're still long. And the recent events have led us to pivot on that. New information, new technical data, flexibility of mindset is actually a strength, not a weakness.
The broader picture now points toward a sustained shift from financial assets into tangible wealth, driven by accelerating currency debasement and structural instability across global markets. What lies ahead is not a straight line higher, but a series of powerful cycles within a larger secular trend. Gold and silver are expected to move significantly higher over time, with silver potentially outperforming as the gold-silver ratio compresses to levels below historical norms. However, volatility will remain a defining feature, with sharp corrections along the way before the next leg higher unfolds. The backdrop is moving toward stagflation, rising inflation, and slowing growth. Capital is shifting from paper markets to precious metals, reinforcing their long-term case. Physical ownership remains central in an environment where systemic risks continue to build beneath the surface. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.